Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
The big topic du jour is concentration, which you had an amazing paper on recently. Maybe tell us a little bit about that paper, and I'll pepper you with some questions as we go along. Where do we stand today? I think since you wrote it, things even got more nutty.
Yeah, a few points on that. First of all, as with all these types of topics, I'm always very reticent to wade into these things. So as you point out, a lot of people have written well about this. But I thought that there were some interesting aspects of it that had not been reflected. So we jumped into it. So the first point was taking a look at concentration, going back perhaps a little bit further than most people have. Now, we had good data back to 1950. We have data going back even further, but I wasn't quite as confident in that data. We found basically is that concentration as of year-end 2023, and we'll come back to your point that it is higher now, was 27%. And that was a level we had only seen most recently back in early 1960, so called 60 years ago. I think the reason it's been on people's radar is that concentration at 27%, this is a top 10 stocks as a percent of total market cap. That number was 13 or 14% 10 years ago. So it's been not only we were at recent highs, but sharp increase in the last decade. And I think that's what has been disorienting for people. Now, if you go back further, you go back to the 1930s, it averaged something in the 30s, so like this is not unusual. Today, I don't know the exact number as we speak now, but it's in the low 30s, 31, 32%, top 10 stocks. So that's the first thing, just to give a little bit of history on this, to understand where we are in this sweep. It's not that unusual. We also went around the world. This may or may not be a fair thing to do, but we said, let's just look at the top dozen markets by equity capitalization. And, the U.S. is actually among the most diversified, in other words, the lowest concentration. Now, that's not really that fair because U.S. is 60% of the global market cap. So as the U.S. goes, so goes the world. And then a couple other aspects we added to this that I thought were interesting. One was, okay, if I gave you, Meb, a clean sheet of paper and you knew nothing, and I said, figure out what you think market concentration should look like in a proper world, how would you do that? So you might come up with different ways and techniques. One of the things we argued for is taking a look at economic profit and saying, okay, there's a distribution of economic profit. Maybe the concentration should reflect whatever the distribution of economic profit looks like. So what was interesting when you examine those numbers as of year-end 2023, again, the top 10 companies were 27% of market cap. They're about 69% of the aggregate economic profit. And economic profit's important because it's return on capital less cost of capital spread. So it's how much you're earning above your economic rents times your invested capital. So the first piece is value creation. The second piece is how much money you can put to work. And if you go back over the last decade, that number has been the economic profit percentage consistently higher than the market concentration. So that's another interesting one. The next thing we wanted to look at was, hey, what happens if you own the big guys, right? What if you own the number one stock or the number two stock or the number three stock? And by the way, I've last read about this probably a dozen years ago. There's a paper by Rob Arnott, Research Affiliates, and Rob was saying, it's horrible to own the number one guy. You really get trashed. And so we created an index. And the way the index works is we started in 49 actually, at $100. And you own the number one stock for that year. And then whatever that TSR was that went in. And then if the number one stock changed, we flipped it, right? So you always own the number one stock for that year from 1950 on. The number one stock, so it starts at 100, this index. That index ended in 2023 at 4, like down 96%. And by the way, what is incredible is that actually represents a huge rally off the low. It was actually at 1.5 or something like that. So the Rob Arnott thing was exactly right, which was, it was for 65 years at least, it was really bad to own the number one stock. Number two, number three did okay. They sort of meander around, but they end up, the indexes are over 100. And by the way, I should say those indexes are excess returns and they're not just total returns. So they're excess returns. But what stood out and what jumped off the page and what was distinct from what I'd read from Rob was in the last decade, those top three stocks were phenomenal. And again, it's the suspects, it's Apple and Google and Microsoft and so forth. And so we had 65 years of history that taught us one lesson, and the last decade that taught us a totally different lesson. And then the last thing I'll say was, it's just sort of an interesting mathematical thing, is that if you're an active manager, so this is now I'm going to say a fundamental active manager, on average, the market capitalizations of the stocks they own are smaller than those in the S&P 500. So we examined, for example, we went to Morningstar Direct, that we looked at 500 US domiciled funds that use the S&P 500 as their prospectus benchmark. In 2023, 400 of them had market caps much lower than the S&P 500. The other 100 about even or bigger. And those 400 just got left in the dust, right? Because when large cap is doing well, basically exposed to small cap, and you get left in the dust in terms of performance. By the way, the other 100 that were as big as the S&P did great. So they were fine. And so the basic trend is when large cap outperforms small cap, active management tends to struggle. When small cap outperforms large cap, which by the way was true in the 1970s, it was true, by the way, in the first decade of the 2000s, active management actually does relatively well in terms of the percentage of funds that beat their benchmarks. So when you talk about all the hand-wringing, one of them is the fact that the sharp ascent in concentration. But what that means by definition is that it's been large cap ripping, and large caps beat small cap in 9 of the last 10 years. And that becomes a very difficult environment for active management. So I think all those things were the things you sort of mix up into the bowl and stir. And that's why a lot of stuff is bubbling up. So a couple of those points, I think, people had alluded to them, but I think were not fully fleshed out. And that's a little bit of what we try to go after.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.